Welcome to Talk Tickers.
Your regular deep dive into earnings calls.
Today, we're unpacking the Republic Services first quarter 2025 call. We'll pull out the key stuff you need to know.
Yeah, think of it as the highlights reel, but with analysis. We'll cover the numbers, the strategy, what's driving things.
Correct, giving you the full picture. So let's jump straight into the results snapshot for Q1 2025.
Okay, so Republic Services, they showed some real resilience. Revenue was up 4%.
Okay, 4%. Decent. But the profitability story looks even better.
Definitely. Adjusted EBITDA, that saw a strong 9% increase.
Wow, 9% on 4% revenue growth. That's leverage.
Exactly. And it pushed their adjusted EBITDA margin up by 140 basis points.
So 1.4 percentage points, landing where?
At 31.6%. Pretty strong margin.
And earnings per share?
Adjusted EPS hit $1.58.
Solid. What about cash flow? That's always key.
Very robust. Adjusted free cash flow came in at $727 million.
$727 million. How does that compare to last year?
That's the impressive part. It's a 36% jump year over year.
36%. Okay, that's significant. What drove that? We'll get into it, I'm sure.
EBITDA growth and working capital timing were the main drivers there.
Got it. Now, pricing is always a big focus in this sector. How did they do?
Pricing remained really strong. Core price increase was 6.1% on total revenue.
6.1%. And what about on their main waste business, the related revenue?
Even stronger there, 7.3%.
Okay, breaking that down further. Any specific?
Yeah, they gave some detail. Small container was up 9.1%.
Wow.
Large container, 7.9%. And residential saw a 6.5% increase. Still very strong.
So they're clearly flexing some pricing muscle. What about average yield?
Also strong. 4.5% on total revenue and 5.4% on related revenue.
So the pricing story looks unambiguously positive. But what about volume? Did that keep pace?
Well, that's where there was a slight dip. Volume actually decreased by 1.2% on total revenue.
Okay. And related revenue volume?
Down a bit more, 1.5%.
Any reasons given for that?
Yeah, they pointed to some tough winter weather, especially earlier in the quarter.
Right, that can disrupt collections.
And also some continued softness in more cyclical markets.
Yeah.
In construction, some manufacturing.
Okay, so external factors partly at play. But despite that volume dip, how's customer loyalty looking?
Seems very solid. Customer retention remained high, over 94%.
Over 94%. That's crucial. Means the core base is sticking with them even if overall volume fluctuates a bit.
Exactly. It suggests the volume dip might be more about specific contracts or cyclicality, not a fundamental loss of customers.
Right. So let's dig a bit deeper then, starting with that revenue and pricing dynamic.
Okay. So achieving 4% revenue growth, despite, as we said, the weather and that cyclical softness, it does highlight the essential nature of the business, doesn't it?
It really does. Waste needs collecting, regardless. And that pricing, 6.1% core, 7.3% related, that's significantly ahead of general inflation, wouldn't you say?
Absolutely. And management confirmed that. They explicitly said their pricing gains exceeded their cost inflation.
Oh, interesting. Did they quantify that impact on margins?
They did. They said pricing net of cost inflation contributed about 40 basis points, 0.4 percentage points, to that adjusted EBITDA margin expansion.
So that's pure profit improvement driven by pricing strategy. That's quite telling.
It shows real operational strength and likely market power.
Okay, let's pivot to the volume side again, that 1.2% decrease.
Right. So besides the weather and cyclical factors, they also mentioned deliberately shedding some underperforming residential contracts.
Ah, so strategic shedding. That makes sense. Prune the less profitable parts of the business.
Precisely. Better margins sometimes means letting go of lower quality revenue.
They put a number on the weather impact, didn't they?
Yeah, they estimated it knocked about $25 million to $30 million off volume, mostly January, February.
Okay. But are things looking up now?
They indicated yes. They saw improving trends in those cyclical volumes, construction, manufacturing, coming into March and April.
Good to hear. So maybe the worst of that cyclical dip is easing. Now, profitability and efficiency, that 9% adjusted EBITDA growth and the big margin jump to 31.6%.
Yeah, let's break down that margin expansion. The underlying business, just operations, contributed 110 basis points, or 1.1 percentage points.
Okay, that's the core improvement.
Then they got an extra 40 basis points, or 0.4 points, just from having one less workday in Q1 2025 compared to Q1 2024.
Ah, the calendar effect. So that part's temporary.
Right. And that was slightly offset by about 10 basis points 0.1 points from the impact of recent acquisitions.
Which is normal, right? Acquisitions often have slightly lower margins initially during integration.
Exactly. So underlying improvement is strong, plus a small calendar benefit, minus a tiny acquisition drag. It nets out to that 140 basis point overall expansion.
Makes sense. What about the environmental solutions part of the business?
Revenue there was up by $25 million year over year. Good growth.
But the margin?
Adjusted EBITDA margin was 20.1%. It was actually down slightly from the previous year.
Any reason for that?
They put it down to the timing of specific projects within that segment and, again, some weather impact.
So more lumpiness expected there, perhaps, but the top line is growing.
Seems to be the case. It's a key growth area for them strategically.
Okay, let's talk cash flow and capital allocation. That huge 36% jump in adjusted free cash flow to $727 million.
Yeah, driven by the EBITDA growth we talked about and favorable timing on working capital. They had a lot of cash come in.
And they definitely put it to work. Acquisitions seem to be a major focus.
Huge focus. They spent $826 million on acquisitions just in Q1.
$826 million in 3 months. Wow. Any notable ones?
Yes, they highlighted Shamrock Environmental. This acquisition boosted their capabilities in industrial waste and, importantly, wastewater treatment.
Expanding into more specialized environmental services.
Exactly. And they signaled the pipeline is still very strong. They anticipate investing over $1 billion in M&A for the full year 2025.
Over $1 billion. So Q1 wasn't just a one-off splurge. They're actively consolidating.
Seems that way. That free cash flow certainly gives them the capacity to do it.
But they're also returning cash to shareholders, right?
Right. Yes. $226 million paid out in dividends during the quarter.
And share buybacks.
A smaller amount, $45 million spent on repurchasing shares.
And they had a nice vote of confidence from the credit markets, too.
They did. Moody's upgraded their credit rating to A3.
A3, that's pretty high grade.
It is. Moody's cited the stable revenue, those strong margins we've discussed, and the robust free cash flow generation.
An A3 rating can help lower borrowing costs, too, which is useful if they're planning more acquisitions.
Absolutely. It reflects overall financial health and stability.
Okay, let's look ahead a bit at their strategic initiatives. The Polymer Centers for Plastics Recycling.
Progressing well, it seems. The Indianapolis facility is set to start its commercial production ramp-up in June. So very soon.
And they have another one coming.
Yes, in Buckeye, Arizona. That one's expected to be completed early next year, 2026. It'll complement the existing Las Vegas center.
So building out a network for advanced plastics recycling, what about renewable natural gas, RNG?
Also moving forward. They expect 7 RNG projects to start operations this year in 2025.
7 this year. Are any running yet?
Yep. 3 were already online as of April, so they're making tangible progress.
And electrifying the truck fleet, how's that going?
Steadily. They had 80 electric vehicles operational by the end of Q1.
80 now. What's the goal?
Aiming for over 150 EVs by the end of this year, 2025. And importantly, they're also building out the charging infrastructure needed to support that.
Makes sense, you need the chargers. And crucially, did they change their outlook for the full year?
No, they reaffirmed their existing 2025 guidance.
Okay. Any caveats?
Just a reminder that the business is seasonal. They noted that strong demand in Q2 and Q3 is, pretty crucial to hitting those full year numbers.
Right. The summer months are usually peak season for waste volumes.
Exactly.
So let's try and synthesize this for investors. What are the big takeaways? That pricing power seems like a major one.
For sure. The ability to raise prices significantly, even when volume is a bit soft, points to a really resilient business model. Essential service, strong market position.
And the acquisition strategy, especially Shamrock Environmental, it looked like a clear push into higher growth, specialized environmental solutions, moving beyond just traditional trash hauling.
I agree. It diversifies their revenue and targets areas that might have better long-term growth prospects or higher margins, less cyclical perhaps.
Then you have the investments in those future-facing areas, Polymer Centers, RNG. That feels like positioning for the circular economy and renewable energy trends.
Definitely. It's not just about today's business, but building revenue streams for tomorrow. They mentioned strong demand signals for recycled PET, which is encouraging for the Polymer Centers.
And the Moody's upgrade to A3 that just confirms the financial stability, right? Makes them look like a safe pair of hands in the sector.
It absolutely does. Lower risk profile, potentially cheaper debt. And it supports that aggressive M&A strategy they're pursuing. Exceeding $1 billion in deals this year is a bold target.
Suggests they see a lot of opportunity to consolidate further. And one last point, their mention of digital capabilities and employee engagement.
Yeah, don't overlook that. It points to ongoing efforts to boost efficiency, improve service quality, things that underpin customer retention and that pricing power we talked about.
So overall, a picture of a company executing well now, managing costs, flexing pricing, and investing pretty heavily for future growth, both organically and through acquisitions.
That sums it up nicely. Strong performance, strategic investments.
Okay, that brings us to our This Is Not Financial Advice segment. Time for an outrageous but plausible trade idea based on what we've heard.
All right, let's hear it. The M&A angle seems ripe.
Exactly. So given Republic's very clear, very aggressive acquisition strategy, planning to spend over $1 billion this year, how about this? You consider a long position in Republic Services itself, ticker RSG.
Okay, betting on the acquirer to benefit from its strategy. Makes sense. What's the other side?
The other side, the more speculative part, is to pair that long RSG position with short positions in a select group of smaller publicly traded waste companies.
Trying to identify potential targets or companies that might face pressure from Republic's growth.
Precisely. You'd need to research which smaller players might fit the bill. Maybe regional players in markets Republic wants to enter, or companies with niche services. The thesis is Republic's consolidation drive benefits them.
While potentially putting pressure on smaller competitors, or maybe leading to messy integration if they are acquired, hurting their stock in the short term.
Exactly. It's a bet on Republic being the winning aggregator in ongoing sector consolidation. But, and this is crucial,
Let me guess.
this is highly speculative. It's an idea, a thought experiment. It is absolutely not financial advice. Do your own extensive research, talk to a professional advisor. Don't just trade based on this.
Sound disclaimer.
Okay.
It's an interesting way to think about the dynamics, playing both the consolidator and the potential consolidation impact. But yeah, definitely requires careful stock selection and risk management.
For sure. Okay, that wraps up our deep dive on the Republic Services Q1 2025 earnings call.
We hit the key financials, the strategic moves, acquisitions, polymer centers, RNG, EVs, and what it might mean going forward.
What are your thoughts? Does Republic's strategy make sense? How significant could those polymer centers become? We'd love for you to think about it.
Remember to always do your own homework before making any investment decisions.
Thanks for tuning in to Talk Tickers. We'll be back soon with another earnings deep dive.